International Monetary Fund and University of Tokyo. I'm Dean Watanabe from University of Tokyo. International Monetary Fund, or IMF, publishes World Economic Outlook twice a year. And the most recent update was released just 2 weeks ago. Many countries, including Japan, is suffering a lot from the COVID-19 crisis. And so people in those countries would like to know what's going on in the global economy, how the government and the central banks reacted to the crisis, and what will happen in the future. In this event, the publication of the World Economic Outlook by IMF gets more attention than usual from the general public. I think many discussions about the crisis are now going on here in Japan, and most of which are closely related to the topics discussed in the World Economic Outlook. So I strongly recommend you to take a look at the World Economic Outlook, which is available at the IMF website. It is very fortunate that today we have a special speaker from IMF. Let me introduce Professor Gita Gopinath to all of you. She is a chief economist at IMF. More precisely, she is an economic counselor and the director of the research department at the IMF. In short, she is responsible for all important policy messages sent from IMF, including the World Economic Outlook. So I'm sure that there is no one in this world who knows more about the global economy than she does. Gita was a professor at Harvard University Economics Department before joining IMF in January 2019. As an academic economist, Gita has produced a number of very, very influential papers in the area of international finance, international trade, and macroeconomics. She did papers on exchange rate, trade and investment, international financial crisis, monetary policy, public debt, and the emerging market, and so on. For example, she recently published a paper in American Economic Review, the title of which is Dominant Currency Paradigm. This is about the invoice currencies used in international trade and international finance. We may be able to hear about something related to this topic in this webinar. I heard from someone that Gita had a plan to visit Japan, physically visit Japan this month to give a talk, which was unfortunately canceled. However, it's very good to have her online today and talk about the crisis with her today. Before starting, let me tell you about how the webinar today is structured. We will have 3 parts. In the first part, I will ask Gita to make a presentation about world economy. After her presentation, I myself would like to ask a couple of questions to her. So this is going to be the second part of the webinar. And in the third part, I will open the floor to questions from the audience. Actually, we had already started to collect questions from the audience several days ago, and we now have more than 70 very good questions from the audience. Some of them from my colleagues and our students, economists in financial institutions, and central bank economists, and so on. I'd like to thank to those who sent questions to us. We will continue to collect questions even during the webinar. So if you come up with a question to Gita while hearing her talk, please submit it online. We welcome any questions about world economy, fiscal and monetary policy, Asian economy, and Japanese economy. Gita is not an expert of the Japanese economy. However, I strongly believe that she will have a curiosity about your question on the Japanese economy. And I hope that she will be happy to answer to those questions. Okay, let's move on to the first part of the webinar. So Gita, the floor is yours.
Thank you, Dean Watanabe. It's a real pleasure to be here and appreciate the kind introduction, as we were discussing earlier, and you told me that you were at Harvard some time ago, so that makes me have an even stronger connection now with you. So let's jump in, and I'll get started with my presentation. To do that, I'm going to share my screen. Okay, so I assume you can see my screen. So what I'm going to present to you is the recent World Economic Outlook that we put out 2 weeks ago. And my first slide is kind of a quick overview of what we are seeing around the world. You know, the COVID-19 pandemic pushed economies into what we call the Great Lockdown, and that triggered the worst recession since the Great Depression. And now many countries are reopening. Over 75% of countries are reopening at this point, at the same time as cases continue to rise in many parts of the world. So the recovery is likely to be highly uneven and uncertain. So what you see on the graph is our projected path for GDP. Now, the blue line is what we had projected in January. This is before the crisis. The green line is what we then projected in April when we put out our April World Economic Outlook. And the red line is our current projection. So what you see is we are projecting a sharp drop in global growth of minus 4.9% in 2020. And then we have a recovery in 2021, but it is a partial recovery because you're still well below the pre-crisis trend line. Now, there are several risks that still remain. There's high uncertainty on the recovery because we still don't have a solution to the health crisis. Financial conditions could tighten rapidly. Geopolitical tensions and social unrest could escalate. And the current crisis could generate prolonged scarring going forward. Now, in terms of policies, given the tremendous uncertainty, the policy advice is to firstly just adapt as the situation evolves because there is tremendous uncertainty. It will remain a priority to help support health systems, shield affected people and firms, at the same time as you support hiring and enable reallocation of resources, ensure soundness of the financial system, and as the recovery strengthens, you want to foster a more inclusive green recovery. Now, international support will be required for vulnerable countries and to continue to improve globalization. So the way we think of this crisis, we coined it the Great Lockdown, and we think there are 3 phases to it. The first phase is when countries were entering the Great Lockdown. That's the first row, and you saw countries putting in strict containment measures. Now, the second phase is when countries are reopening, and many countries are reopening, and that's the second row. But we call it a tentative exit because in the absence of a medical solution, there is a possibility that countries will go back into lockdown, either de jure or de facto. And then the third phase is when there is a medical solution. So you either have very effective treatments so that this becomes like an ordinary viral infection, or we have a vaccine. And that's when the world truly escapes the Great Lockdown. We're not there yet. What we're seeing is cases around the world that continue to grow, especially in emerging and developing economies. So the pandemic is everywhere at this point. It started early in some places and have stabilized, but as you can see, it's across the board in advanced economies, emerging markets, low-income countries. Nobody has been spared. In that sense, it's truly a global crisis. Now, what I'm going to walk through in my next slides are what we're seeing in terms of the impact in the global economy in the first phase and in the second phase as countries reopen. So the first feature of this crisis is how the service sector has been hit hard. So this is quite unlike previous crises, where typically the service sector is spared because consumption spending, even if it falls, it doesn't fall as much as, for instance, investment does. But this time around, because this crisis has meant people have stayed away from going out and spending in restaurants and so on, there's been a big drop. And so you see that in the left graph. You can see for advanced economies, for emerging and developing economies, and you can compare manufacturing and services. And if you look at the red bar, that's when you had the peak contraction. And you can see that the effect on services, the red bar, was much more severe because a shorter red bar as opposed to manufacturing. And now with the reopening, we are seeing signs of recovery. Now, in the case of services, as you can see, it's still below the 50 line, which means that it continues to contract, but at a much smaller rate. And it's very closely tied. What the middle graph shows you is that this drop in services is very closely tied to the decline in mobility in different countries. Another sharp feature of this crisis is the speed with which employment has dropped in many parts of the world. And you can see that for the US, and you start seeing signs of recovery at this point. So that's the first kind of unique imprint of this crisis, the service sector being hit hard, employment collapsing in a speed and scale that's not been seen before. If you look at the recovery, what you see, if you look at the leftmost graph, is that the recovery is uneven, which means that some sectors are recovering much faster than the others. So the left graph shows you China, and you see that there was a steep fall across the board, and especially in some sectors like catering services. And they are also the ones that are taking longer to come back into positive territory. The middle graph shows you the same thing for the US, and you have a big drop in restaurant bookings that happened. And while you've seen sharp recoveries in retail sales, restaurant bookings still remain well below. So this is the sense in which you have an uneven recovery. Also, we saw a big collapse in trade, and now some early signs of recovery. So that's the second feature of this crisis, the uneven nature of the recovery. Now, the third is a question that came up was because this crisis has both big supply and demand shock components to it, there was a question of whether we would see increasing inflation or disinflation. And what you see is that you did have an increase in food price inflation in many parts of the world. But if you look at consumer price inflation, that came down, and that's also because of the drop in commodity prices. But even core inflation has come down in many parts of the world. Commodity prices have recovered from their deep lows, but you have countries in the world that are big commodity exporters that are getting hit very hard by this commodity crisis. Now, what has happened in a positive and an unprecedented way is the dramatic monetary and fiscal policy support. So the left graph shows you the amount of fiscal measures that have been announced. They now stand at close to $11 trillion in the world. The vast majority of it is in advanced economies, but there has been also substantial support in emerging market and developing economies. What the middle graph tells you is that many of these schemes have been very successful, especially in advanced economies, in replacing lost income for people. You've just had replacement rates have been very high in terms of the income that was lost. And the right-hand side graph shows you that monetary policy measures have been, there have been ambitious monetary policy steps that have been taken around the world, not just in terms of policy rate cuts, but providing liquidity. And for the first time, many emerging markets have delved into quantitative easing, which was something that we did not see before. Now, because of that massive policy support, there was one positive surprise that happened in the last few months, which is the easing of financial conditions everywhere. And so you could see in the left graph that in the beginning, there was a big collapse in capital flows to emerging markets, but then that stabilized relatively quickly. And most recently, you can see them recovering. For instance, if you look at emerging Asia. Another feature that you saw was that countries that had very large depreciations of their currencies in the first few months of this crisis have now seen some reversal, and now you're seeing some appreciation in their exchange rates. So this has been one positive surprise that we came out over the last few months. So now, if you step back and ask the question about, if you look at the cross-section of countries around the world, what do we see in terms of the relationship between economic losses and the severity of the pandemic? What the left-hand graph shows you is that there is a weak relationship, in the sense that countries that had higher death rates per capita took a bigger hit to their GDP, but the relationship is still weak, and this is a relationship that needs to be continued to be explored. The relationship that's stronger is the one that relates to mobility, which is that in parts of the world where you saw the biggest drop in mobility, that's where you've seen the biggest drop in GDP, looking at first quarter GDP numbers. So I'm going to jump into what your projections are. And we, of course, given this environment we live in, we have to be very clear about what our assumptions are. I've listed the assumptions here. I'm not going to read everyone out. But the question, of course, is what have we assumed about a recurrence of infections in the second half of this year? So what we are assuming is that there will likely be a recurrence of infections, which means that people will voluntarily social distance for much longer. However, we are not projecting that there will be the same kind of stringent lockdowns that were put in the first half of this year. So clearly that is an assumption. So let's look at the projections. These were the numbers we have for the different countries of the world, advanced economies of the world. For the globe as a whole, we have growth at minus 4.9%, and then it's rebounding to 5.4%, but that's still only a partial recovery. Very large negative growth numbers across all the different countries. Similarly, you see that for emerging and developing economies. I could have flagged Japan in there, minus 5.8% is a projection for 2020, and then 2.4% recovery. For emerging market and low-income countries, similarly, very large negative growth reductions. So some of these numbers look smaller than advanced economies, but that's just because many of these countries are projected in normal times to grow at much higher rates than advanced economies are. If you look at the whole path of GDP, you can see from the blue line that for advanced economies, we have a recovery where even by the end of 2021, they're below the pre-crisis level. Similarly, that's true for emerging and developing economies if you exclude China. China is the country for which we have a more stronger recovery going forward. Overall, for emerging market and developing countries, excluding China, we are projecting a bigger hit from this crisis as compared to advanced economies. Now, there are other possibilities. I think there are upside risks, which means you could have better outcomes. So if you have better news on the treatments or vaccines, you could see a recovery much faster, and that's a green line. But if there is a serious second wave that brings down activity to the same way it was in the first half of this year, then we are basically looking at an L-shaped recovery, which is basically no growth in 2021. Now let me quickly walk through the risks. Among the major risks, the number one risk is the one of, again, the fact that the health crisis is still ongoing, and so the risk of second and third waves and rising infection rates. And what we see is that countries that reopened at the same time that the number of cases were growing is where you're actually seeing the biggest uptick in the number of cases. A second risk is the middle graph. It says that financial market conditions have improved substantially, but if there's worse news, that could change and that could trigger much more distress. And the geopolitical risk index is still it's going up, and so the risks are there on that front too. A second important factor to keep in mind is that given the very large fiscal stimulus that has been put in place, and given the collapse in economic activity that's being projected, global public debt levels are projected to be at the highest level since the Great Depression. So you can see that there, it's even higher than the post-World War II peaks. So obviously this has implications. Countries are going to come out of this crisis with large amounts of public debt, and they will have to find ways to bring that level of debt down. The right-hand side graph tells you that all this exposure also in terms of fiscal support and weak activity has meant that many emerging markets are also now in have high or medium vulnerabilities on the fiscal front and on the external front. Lastly, I think it's important to think about what will happen going forward in the sense of what kind of a world will we end up with. On the left-hand graph, what you see is that there are countries that rely on tourism for whom this hit, is almost an existential crisis. Because you can see, for instance, 2020 daily inbound flights to the Caribbean that plummeted and that has stayed low. The middle graph shows you that in the absence of government support, we could see a large-scale increase in bankruptcy rates. And that obviously has implications for the strength of the recovery. And the third graph tells you, rightmost graph shows you that this crisis is likely to lead to an increase in global poverty after it's been declining. So this would be the first in over 20 years. These are World Bank projections. Now, of course, I want to end with something a little more positive, which is that there are also opportunities as countries rethink how to invest in public goods coming out of this crisis. And on the left-hand side graph, what it shows you is global carbon dioxide emissions. They came down during this crisis, but they are projected to go back up as economic activity recovers. This is an opportunity to bring about a green recovery in economies. Similarly, investing in digital infrastructures, digital transformation would also be a very promising path for economies around the world. My last two slides goes into policy recommendations. There is a lot of detail in there. I am not going to go into every part of it. The recommendations tell you depend upon the phase you're in, which is the first phase was when we had the strict containment measures in place. And at that time, governments needed to support workers and firms directly, make sure that there was income support for people, and firms were supported through wage subsidies and through credit guarantees and so on. Over time, as the recovery gains strength, you would see a gradual shift from protecting jobs, but as opposed to encouraging a reallocation of workers towards sectors that are growing. You will continue to need to spend on healthcare capacity. Timely testing, tracing, isolation would be required. And you will continue to need central bank support, ensure the financial systems remain sound and can support the recovery. And again, seize opportunities to make recovery green, more equal, and digitally friendly. Lastly, this is a truly global crisis, and if there was ever a time for international cooperation, this is it. International coordination and support will be essential. We will need to guarantee adequate health supplies, data sharing, remove trade restrictions on essential medical supplies, make sure that there is sufficient production and delivery of vaccines when available, ensure that developing countries can finance critical spending, and international liquidity needs are met. And countries need to work together to improve the rules-based global trading system. And at the IMF, we are actively working to support our member countries. So with that, I will stop and hand it back to you, Sutomo.
Okay, thank you very much, Gita.
I'm going to stop sharing my screen. Okay.
Thank you very much, Gita. Let's move on to the second part of the webinar. I'd like to use my privilege as a moderator to ask a question to Gita. So now you are a student, and I'm a kind of a teacher to you, okay? And I have prepared a couple of questions, and let me share my slides. Can you see the screen?
Yes.
So, so you're now physically now in Japan. So I'm going to start with a question about the Asian economy, and after that, I'm going to ask about inflation deflation, which is a very popular topic here in Japan because we are suffering from long period of deflation here in Japan. And the third one is about zombie lending. I'm going to talk about. I'm going to explain what it is, and finally, I talk about real-time data. So let me start with the Asian economy. So here, so the first thing I'd like to show is this figure, which is very similar to the figure you showed in your presentation. To the vertical axis, sorry. So the vertical axis is real GDP growth, which is taken from the World Economic Outlook, and the horizontal axis is this per 1 million population. So what we are looking for is a negative correlation between the two, and there is some negative correlation between the two. So which means that if the health shock is stronger and more people die in that country, real GDP growth is lower. That's the meaning of the negative correlation. However, this negative correlation is not so strong, and it's actually very weak. And so in particular, it is so for Asian countries. Here red squares represent Asian countries, and the blue one are the rest of the world. And it suggests that very important things. First thing is that the number of deaths in Asian countries, including Japan, is very, very small, much smaller than the number in Europe and North and South America. However, growth rate in Asia are almost as bad as those in the rest of the world. For example, if you look at Thailand, so this is Thailand, and the number of deaths is only 0.83, so it's very small. However, growth rate is almost minus 8%. Here you have a US, so the number of growth is almost the same as in Thailand. However, the death is more than 300. So the big difference between Thailand and US in terms of the deaths. However, in terms of growth rate, those two countries are almost the same. So there is a huge asymmetry between Asia and other parts of the world. So my question is why this is so. So in summary, health shocks in the Asian countries is much smaller in terms of magnitude than the rest of the world. However, economic damage in Asian countries almost the same as in the rest of the world. So I can think of several possibilities. The first possibility is a sort of spillover effect. Maybe if you remember the global financial crisis, spillover through financial linkage or spillover through trade linkage were very important in the global financial crisis. However, as Gita emphasized, the crisis this time is quite different from the financial crisis in the sense that shocks happen almost entirely in the service sector rather than goods sector, which means that, of course, the service sector is non-tradable. So it's hard to imagine that the spillover effect is playing a very important role in this spillover process. So I don't think this is a good explanation to the phenomena. And the second explanation, which may be very important, is sort of overreaction by Asian countries, overreaction by Asian consumers, overreaction by Asian governments, including Japan. Which means that we look at what's going on in Europe, what's going on in the US, and some very, very bad things are going on. And mass media and the SNS always say that similar thing could happen in Japan and Asian countries. So Asian consumers are very much aware of what's going on in the rest of the world. So they became very precautionary. So they consumed less than usual. Also, the government in those Asian countries reacted very aggressively to contain the outbreak of the virus. So these sort of overreaction by consumers and overreaction by government could be another explanation to the phenomenon which is happening in Asian countries. So my question is to Gita is do you have any thoughts on the Asian situation? In particular, why growth rate in Asian countries, including Japan, are so low in spite of the health condition is not that bad as in the rest of the world. Oh, your microphone is mute.
Yes, thank you. Yes, that is a great question. And it is indeed quite closely linked to the figure that I showed you in my own slides, where I looked at the relationship between the decline in real GDP growth, the surprise component of it, and related to the death rates per capita. And what we also see is a weak relationship. So the relationship has the right sign, which is places where you see a worse health crisis, the economic activity is bigger. But I think we have to still wait to confirm that relationship. I think it's a weak relationship and we have to confirm it. Now, I think what we are seeing from the cross-section of countries is that in many places, it's not necessarily the actual containment measure or the actual intensity of the health crisis, but the fear associated with it. And that has led to a lot of holding back of activity. So one variable where you actually see a very strong relationship is when you look at the relationship between mobility and economic activity. There you can see exactly a very strong relationship, which is places where mobility fell by the most, economic activity was hit by the most. So the question is, what explains why mobility falls so much in one country versus another? And we know it's not just about how strict the containment measure is, and it's not just about the health factor. Secondly, I agree with you that this is a crisis where mostly what's being hit is domestic consumption. But one sector that's been very badly hit is tourism and travel. And so if you look at Thailand, for instance, is a great example, because about 20% of GDP is tourism in Thailand. And so this crisis has had a very big hit on countries that rely on tourism, which is why you've seen a big big negative effect. Then there are other countries where this crisis has also been a big hit to commodity prices, and they're commodity exporters, and you've had a big hit come from that. There are some countries that rely much more on international financial market conditions. They've been hit badly. And then you also have countries differing in the amount of policy space they have. So everybody can get hit by the same crisis, but then because they have less policy tools to use to respond to the crisis, you have a differential effect on economic activity. So I think all these variables matter. The question is, we will need to keep looking at the data going forward, and this will probably be fuel for research for many years to come in trying to understand what this relationship was. But I think a common thread going forward is that when countries have to deal with future waves of this crisis, that doing so in a more targeted manner is beneficial, which means that you start early as soon as there's an eruption, target the local area. That's one. Second, better targeting in terms of some groups are much more vulnerable to this virus than other groups are. So you have differential isolation. Contact tracing is very helpful, and very strong communication so that you can assure people that if there is another outbreak, it will be handled well. Because that, as we just discussed, seems to be a number one factor in how much people decide to go out and engage in economic activity.
Yeah, thank you very much for a very good answer to my question. Yeah, actually, it's true that Thailand is kind of relying heavily on tourism, and that's one reason why Thailand growth rate is much lower. However, think about Japan, and of course we rely much on tourism, but still we export many other things, and so we are not relying singly on tourism. However, growth rate is very low right now, and your projections are also suggesting that growth is very low here in Japan. So I like your explanation about the fear and people fear about what's going on. There's a huge uncertainty about the virus, and even Japan, people are very much afraid of what's going on in the future. So they try to stay at home so that they cannot get the virus in the town. So that kind of fear played a very important role in their consumption behavior. I agree with that. However, if you think about the future, let's think about the second wave. Okay, probably in some near future we will face a second wave. But now we already, Japanese and the Asian people already know that health shocks is quite different across Asia and other parts of the world. So maybe Japanese or Asian people think that we should not afraid risks as you do in the US or European countries. So for the second shock, as far as the second shock is concerned, second wave is concerned, maybe our behavior could be different from the rest of the world. Do you think that is that then the economic growth would not be that much bad as it will be in the rest of the world? Do you think that could be? Yeah.
I think there is certainly reason to believe that countries who've been able to keep the number of cases low, the number of deaths per capita low, that they will have, that people will feel more confident about going on their work. So for instance, if you look at different places that have reopened and you look at how much of activity has come back, you see that places where the number of cases came down quite substantially, you actually see reopening and you see an increase in mobility. But in places where you reopen, but the number of cases are continuing to go up, you don't really see that increase. So people obviously care about how the health crisis is being managed. And if it's managed, people see that it can be managed well. And of course, in the case of Japan, also people have very good personal practices in terms of, social distancing, wearing masks. I mean, those have also helped, which while the rest of the world had to learn how to do it.
Do you think this is a stupid idea? If say IMF says that yes, Asian countries is kind of very strong in terms of health condition, so you should work very hard. However, in Europe or maybe in the North and South America, in those countries, people are very, very vulnerable to the shock. So you should stay at home. So that kind of coordination among countries in terms of reopening. Do you think that the IMF can play some role in that kind of coordination?
Firstly, I'm not sure we should be giving that particular advice. I think all countries will have to get to a point where, yes, in the first half they were not prepared. The people were not used to, were not taking these kinds of precautions. The lockdowns were very widespread and generalized. But I think now we have the health capacity. Doctors know how to treat this virus better than they did in the beginning. So I think every country is now in a better place going forward, and they should continue to improve that.
Okay, let me move on to my second question, and I have to share again. Which is about inflation or deflation. Okay, here so this is I'd like to share two slides, two figure with you. One is about Spanish flu which is coming from a paper by Robert Barrow and so on. And so it was 100 years ago. There was something like a pandemic, and inflation rate increased significantly during that period. So this suggests that the shock at that time was kind of driven by supply side, and also supply shortage was very serious, which give a very strong upward pressure on prices and wages. And another figure I'd like to share with you is this one. This is coming from Japan, and this is the inflation rate at the daily frequency. This is estimated using scanner data. And can you see this? This green part represents a state of emergency. So the blue bars represent the degree of stay at home for Japanese people, and the red line is the inflation rate at the daily frequency. And you can see that during this emergency period, of course, people stay at home, and also people buy something at supermarket, and so the demand at the supermarket was very, very strong. So inflation rate actually increased significantly, and it reached almost 2%. 2% is a kind of target level for the Bank of Japan, so it increased a lot during this period. So as far as goods prices are concerned, prices went up, which is again consistent with your slide, and of course service prices declined substantially even in Japan. So I'm not saying that a similar thing as we observed during the Spanish flu is actually happening in Japan, but I have to emphasize that goods prices and service prices behave quite differently in Japan, and probably the same thing is true in the other part of the world. So my question is it likely or unlikely that prices will go up sometime in the future? Not only goods prices, but also service prices will go up sometime in the future, and probably due to supply shortage. And another related question is, some people in Japan worry that import of food and raw material from countries like, let's say, Brazil, will likely to rise substantially due to accelerated outbreak of the coronavirus in those countries. So that imported prices will rise, ending up with high inflation in Japan. Do you think that this is kind of likely scenario in the future? So this is all about inflation and deflation question.
Yes, happy to answer that. So the slide that you have on inflation shows you that during those years of the Spanish flu, you had this spike in inflation. But my reading of that paper by Barrow and co-authors is that if you look at what was real meaningful for inflation, it was less the flu and more the World War. So the First World War was around the same time, and you had the consequences of it, which was much stronger. That had a much bigger role to play in explaining the high inflation that followed, as opposed to the pandemic itself. So what's different between the wars and the pandemic? Of course, in the wars, you had a big destruction of physical capital. And you saw that in, and that's something that's not happening, obviously, this time around. So we don't have a big destruction of physical capital. So that big supply shock is not there. What we have seen this time is, the fact that food inflation did go up in several parts of the world. It was an increase in demand for food inflation that went up. But on the other hand, other sectors that are kind of the non-essential sectors, there you started seeing price inflation come down. And now, because the consumption bundle is also much more skewed towards these non-essential, spending as opposed to food, the effect on overall consumer prices is much weaker. Now, to your question about going forward, what do we expect to see? I think our overall expectation is that, yes, there can be pockets where prices go up, like the example you gave of Brazil. if there is big supply chain disruption, certain materials and food could spike up. But overall, we think that inflation is going to stay low, because if you look at the effect on job markets, and if you look at employment, we don't really expect to see wage price inflation coming anytime soon. That's one. Second, and this is also an important difference between now and at the time of the Spanish flu, is that we have central bank policy that has been quite successful in anchoring inflation expectations, unlike in the past. And so now you might have a spike in food price inflation, but people don't then extrapolate that to overall CPI inflation. And so putting the two together, I would say that at this point, we probably have more of concern of inflation going too low as opposed to overall inflation going too high.
Okay, thank you very much. It seems that we are running out of time, so I will move on to the questions from the floor, and I'd like to share the question with Gita, and Gita will say something to the question. So the first question is coming from Hiroshi Ugai, JP Morgan. And Ugai-san's question is about policy mix and the policy space. Okay, so let me read. Growth rate in advanced economies has just bottomed out, but the expected partial recovery in 2021 means that output gap will continue to be in the negative territory, indicating that the deflationary or disinflationary pressure will not fade out, and credit costs may increase as firms' balance sheets are expanding. In this environment, policy support should gradually shift from being targeted to being more broad-based, but the government should turn to the fiscal tightening eventually, and the central bank's monetary policy is closer to the limit. What do you recommend in general the appropriate choice or combination of accommodating macroeconomic policy under such conditions after exiting the emergency situation? That's a question from Ugai-san.
Yes, thank you. So again, in terms of the stance of fiscal policy and monetary policy, I think we are still in a crisis. We're not out of the woods, and so support will be needed on both fronts. Now, the question is, what phase of the crisis are we in? Are we now, which is that we are reopening, but still the health crisis is not over? That's going to be a different set of recommendations as opposed to when the crisis is completely over. I think all governments around the world are dealing with the following issue. One, because this is a massive real shock, the issue is more about solvency as opposed to liquidity, which is that we have a problem where we're going to see firms becoming insolvent because they go through many months of loss of revenue as the longer this crisis gets. That's one. Second, governments have to deal with the fact that there is tremendous uncertainty because you just don't know when to pull the policy off because you don't know which stage of the crisis you're in. And the third is the more longer this gets, the more governments need to encourage reallocation of workers. And the question is, when do you do that? I think in terms of the policy response, what it means is that because there's a bigger insolvency issue here, government support will have to shift more towards being equity-like as opposed to debt-like. Because otherwise you will end up with a lot of firms that exit this crisis with huge amounts of debt overhang, and you don't want that. The uncertainty means that you're going to have to put policies in place on a temporary basis for like a few months and then reassess as things improve. And the reallocation aspect means that, yes, in the first phase, a lot of the support was to keep workers and firms matched. But gradually, you're going to have to recognize that some sectors are never going to come back to their pre-crisis level. So you want to separate workers and firms at that point and shift them towards growing sectors. How do you do that? Well, you want to still protect people, so you still give them something like unemployment insurance, or if you're in informal sectors, you give them cash transfers. But if you are from the firm perspective, you give firms hiring subsidies so that they can hire workers, especially very young workers and older workers who tend to have much harder time finding jobs after a crisis, and also reskilling for workers so that they can adapt to new sectors. So those kinds of measures will be needed. So the policy mix has to change, and then eventually you go to much more, what we call a broad-based support, which is basically a tool like public investment, which is then going to stimulate activity. And there, we think that it's important for this to be a green recovery and to be a digital recovery, and that would be the next step in the support.
Could you elaborate more on the difference between equity-like support and bond-like support to farms?
Yes. So, if the support takes the form of giving loans, then of course you come out of this crisis and you have this debt, and then regardless of whether things are getting better or worse, you have to repay this debt, and that's like a big tax on you, and that prevents you from investing. But on the other hand, if the lending takes the form of being more equity-like, which is that you get paid when there's a good state of the world and you don't get paid when there's a bad state of the world, then that's less onerous on firms, and that would make it easier for firms to also recover from this crisis.
Second question is from Taisuke Nakata. He's my colleague at the University of Tokyo. And this is about, Nakata-san's question is about low inflation and policy choices. And he asked, in 2019, IMF recommended to the Japanese government that the BOJ should introduce inflation range rather than inflation pinpoint target, rather than target, but range, inflation range, to increase policy flexibility. That's the recommendation made by the IMF in 2019. And I see a non-trivial chance that in the post-COVID-19 world, other advanced economies, including Euro area and the United States, will eventually look like Japan last year, with a strong labor market and with inflation below target and the policy rate at the lower bound. If so, do you think it is sensible for the ECB and the Fed to consider introducing inflation range, as you recommended last year to the BOJ?
Yeah, thank you. Great question. So, as you know, the ECB and the US Fed is also going into, and they're re-examining their monetary policy frameworks to figure out how to best do, satisfy their mandate. The way I think about it is that monetary policy has a mandate of meeting an inflation target. In the Fed, of course, it's dual mandate: it's price stability and full employment. But let's say that countries have a mandate of meeting a particular inflation target. And the question is, in the attempt to meet that inflation target, can you end up creating large amounts of financial instability, right? And that is a concern. Now, one channel through which you can deal with both is that monetary policy focuses on the inflation target, and you have regulatory policy, what's so-called macro-prudential policy, that focuses on financial stability. So to the question of what's the advice for the different countries, I would say that it matters, one, on where you think the real rates are going to be for these different countries, the real interest rates are. Now, Japan has aging demographics, which weighs heavily on the real interest rate, pushes it down. That's not so much the case in the US. Europe is somewhere in the middle. So these countries differ in terms of those fundamentals about where we think the real interest rate is going to be. Second, countries can differ in terms of the strength of their macroprudential setup and how many different tools they have. So ultimately, the advice is going to depend on these particular features. I think what is probably more true for most central banks is to have a much more symmetric target, which is that it's not just that you want inflation to meet the target from below, but you don't want it to, you're okay with it going above target slightly too, right? That it's not that you want a ceiling, but you want that inflation can actually go above target too. And you hear that, I mean, the US Fed, when it's been in its commentary, when it's been talking about its monetary policy review, it's talked about, catching up, which suggests that they would let inflation go above a target for some time. So I think that's the mix. But again, what exactly is the advice will depend upon these other factors I talked about.
I think I'd like to take one more question. This is from Takuji Kawamoto from the Bank of Japan. And this is about, again, policy issue, but from a very longer term perspective. And he said, the coronavirus shock will presumably result in hysteresis, especially with regard to effect to potential growth rate. On one hand, measures taken to prevent infection, such as social distancing, will inevitably mean lower productivity for tourism and other services, such as hotels and restaurants. On the other hand, the pandemic has, in a way, acted as a trigger for digital transformation. And this has the potential to increase the overall productivity. So there are two different factors to potential growth, but with the opposite direction. And his question is, he would like to hear your view on the hysteresis aspect of the crisis. How persistent effect will remain even after the shock ends?
Yes, this is another very good question. I don't think I can say quantitatively I know the answer to it, which is that what exactly is potential growth rate going to be coming out of this crisis? We don't have a projection for it right now, for the simple reason that it's also uncertain how long this crisis is going to last. And the effect on potential output is going to depend on how long this crisis lasts. We know that potential growth is going to be affected because, one, we are seeing weak investment around the world, which means that the capital stock coming out of this crisis is not going to grow as much as it would have in the absence of it. So that has an effect on potential growth. Second, we are seeing for sure in terms of productivity, the factor you mentioned, which is that because you need to make your workspace safer to protect against a pandemic, you can have a drop in productivity. We're also seeing, of course, a hit to human capital because you've seen schools being shut down and there is remote learning going on, but it's not perfect. And this is particularly a big concern in lower income countries where they don't have access to the internet. And for them, there's just lost schooling days. And there's a negative effect that comes from that. So, and then we have the balance sheet concerns, which is that we're going to see firms that come out of this crisis, some of them which have damaged balance sheets, that takes a long time to unwind. Labor market hysteresis is there. So there are many, many factors in there. Yes, on the plus side, we have the digital aspect of investment that can come about and the productivity can come from that. And that's a positive. But I think there are many other aspects that push productivity towards the lower end. And again, how big an effect this is going to be depends upon how long this crisis is going to last. So in our October World Economic Outlook, we're actually going to have more of an analysis on this particular question.
Okay, thank you. We have received many questions from the audience, but I'm very sorry that we are not able to cover all those questions. However, I strongly hope that we will be able to repeat this kind of event, in particular with Gita, and sometime in the future, so that the discussion will continue with IMF and Gita. And finally, I'd like to thank Gita for attending the webinar, and I sincerely hope that we will be able to have you on our campus, not a cyber campus, but on the physical campus sometime in the near future. Thank you very much for attending this webinar. And also I'd like to thank the audience for coming to this webinar.
Thank you, Sutomo. I really appreciate this interaction. I felt like we could have continued with this conversation for much longer. The great questions, and the audience was great too. The questions that came were fantastic. So thank you. And I really hope I can come to Japan. Never been to Japan before, but I hope I can do so.
Okay, thank you. Bye-bye.
Thank you.